Welcome to this webinar done in conjunction with the White Coat Investor and with Laurel Road, all about student loans, how to manage them, what to do with them. We'll also be telling you more about Laurel Road today, which is one of our longest term partners here at the White Coat Investor. We're always grateful for their sponsorship. Here from Laurel Road to help and to present today is Alex Maselak, the Director of Business Development at Laurel Road. Alex, thank you for being here today.
Yeah, thanks, Dr. Dahle. Excited to be here. It's been a great long-standing relationship with White Coat Investor. So excited to share some updates on the student loan landscape and navigating best practices to repay your loans.
Yeah, well, without further ado, let's get into the presentation today, and let's teach people some cool stuff about student loans.
Sounds great. On the agenda, I think first and foremost relevant for people to understand the CARES Act and how that impacted federal student loan repayment. So we'll cover that. That is a moving target, as I'll explain, and then start to cover some more traditional federal repayment programs. I think most people are pretty familiar with, like income-driven repayments, public service loan forgiveness, and start to compare and contrast refinancing versus federal loan repayment. What are the pros and cons of each, considerations, for which path to go down. And then we'll dig into what we do at Laurel Road. So we're a bank. We do student loan refinancing. We are able to pay off your loans, give you a new loan at a lower interest rate. So I'll talk about what exactly that entails. And we do have a special refinancing program for residents and fellows with reduced payments during training. So we'll cover that along with the bonus that we give all White Coat Investor and Physician on Fire readers. So should have some time for questions here at the end. I'm sure there will be some, but let's start by covering this CARES Act, which has now been almost 3 years, since it was initially announced when COVID started. And the big impact on student loans was there's been a pause on federal student loan interests and payments since this was announced. So originally it was going to run for 6 months as people thought COVID would just sort of peter out. It has since been extended 9 times through executive orders, the most recent one coming just last week. So now those with federal student loans are not asked to pay anything through the end of next June. So very much remains to be seen how this plays out, if it gets extended again, if it in fact does come to an end next June. But suffice to say, those with federal student loans have had a pretty good deal for the last almost 3 years now, not having to pay anything and not being charged any interest. I think what's great, especially for a lot of physicians out there, these months of $0 payments count if you're pursuing public service loan forgiveness. So, if you're planning on getting your loans forgiven by working at a nonprofit, these last 3 years of quote unquote $0 payments have counted towards your 10 years towards loan forgiveness. So really nice benefit there. So just recently, and this is as much a moving target as anything in the student loan industry, the Biden administration announced that there was going to be this wide sweeping forgiveness event. Anybody who has federal student loans making below $125K for a single person, $250K if you were married, would get up to 20 grand forgiven on their federal student loans. That was contested in a Texas court, I believe, and has basically been put on hold. So the likelihood is that this executive order is going to go in front of the Supreme Court, who's going to decide if it's constitutional to forgive all of these student loans for people across the country. So that is, I guess, up in the air right now. When the executive order took place, everyone assumed it would just go through and people would have their loans forgiven. There's been some contesting of that, I would say. So, would recommend folks keep a very close eye on the legislative ongoings there. It's obviously, a pertinent decision for so many student loan holders around the country. This recent extension on the payment and interest holiday was in light of contesting the forgiveness. So I think the administration's plan is to basically not turn the loans back on, not turn payments and interest back on until we get some clarity on the forgiveness situation. So one additional note on here, there has been a proposed new income-driven repayment plan. I'm going to cover income-driven repayment in a little bit, but right now, anybody paying based on their income is paying at least 10% of your income. This proposed plan would reduce that to 5%. Again, this is just a proposal, still needs to go in front of Congress. I think we all know what that can entail and how long that can take. So be aware that it has been proposed, but by no means solidified yet. A couple terms to know that'll get referenced throughout the presentation: consolidating versus refinancing your loans. Consolidating means that you're just lumping all of your loans together into one big loan with the Department of Ed. Doesn't change your rate, just simplifies your repayment life. Whereas refinancing is when you're going to a private lender like Laurel Road, and we would pay off your loans, some or all of them, and give you a new loan at a different rate, oftentimes a lower rate. This rate when you refinance is based on your creditworthiness. So your FICO score, your income, your total debt, that's what goes into eligibility to refinance and the rates that you're offered. Fixed versus variable rate loans. Fixed are going to stay the same rate the whole life of the loan. Variable adjust every quarter or month, depending on the economic interest rate environment. So right now they are probably going up. Rates across the economy are going up. Generally, we see a lot of people right now who are refinancing taking fixed rates in light of this rising rate environment. But we do offer both, as many lenders do. And then deferment versus forbearance. So both are non-payment statuses on your student loans. Deferment is what you're in while you're in school. You're not making any payments. But you are not responsible for your subsidized loan interest while you're in deferment. When you're in forbearance, you are responsible for all the interest that's accruing on the loans. Generally, deferment only available while you're in school. Forbearance is what would be available if you needed to pause payments thereafter. And then some questions to be asking yourself, things that are important to be aware of as you formulate your repayment plan on your student loans is what type of loans do you have? Is it federal, private, undergrad, medical school? How many loans do you have? What are the interest rates? Really logical first step is to determine where you stand today, as that's going to have a big impact on what options are available to you. So delving into some of these federal repayment programs, I'm sure you hear about them from your financial aid office. Direct consolidation. Like I said, this is when you go to the Department of Ed. You probably have a dozen different loans or more with 4 or 5 different lenders, and you combine all of those loans effectively. So they just take the weighted average interest of all of your current loans. That becomes the new rate on your consolidated loan. And it makes life much, much easier. Instead of worrying about, writing a dozen different checks to different lenders every single month, you now just wind up with one loan. Also ensures that your loans are eligible for public service loan forgiveness. So the outcome is a direct loan, a direct federal loan. Only direct loans are eligible to be forgiven through public service loan forgiveness. So we'll cover that in a little bit. Income-driven repayment. I'm sure everybody is familiar with this concept. It's extremely relevant for residents. It allows you to pay based on your income and family size, as opposed to what you owe. So instead of paying on what's oftentimes a $250,000 debt burden, you're going to pay based on a more modest residency or fellowship salary. So your payment isn't a financial burden. It basically just ensures that you're paying something that you can afford. And there's currently 4 different iterations of income-driven repayment programs. Every seemingly 3-4 years, a new one gets rolled out by a new administration. Like I mentioned earlier, there's been a proposed 5th income-driven repayment program. that would reduce the monthly payment obligation from 10%. So that's what pay as you earn and revised pay as you earn ask you to pay. This new program that they've proposed is only 5%. And one interesting feature of these income-driven options is the forgiveness component at the end. So if you were to pay for 20 or 25 years, depending on the program you're in, at the end of that time, anything remaining on the loan gets forgiven. The caveat with this forgiveness is it's taxable. So if you had $100,000 forgiven after 20 years and pay as you earn, that $100,000 is treated like taxable income, like you earned an extra $100K that year in income. You'd have to pay a tax bill on it. So it doesn't negate its value totally, but it's definitely a consideration in determining, is this something you'd like to pursue long term? And a really relevant federal program, especially for physicians, is public service loan forgiveness. So really 4 boxes to check to set yourself up for this forgiveness event, which is available to those working at nonprofit. So about 85% of hospitals in the country, nonprofit, or government entities. If you're working in that type of setting, you can potentially have your loans forgiven after 10 years of qualifying payments. And the way that you set yourself up for this forgiveness is, number one, only federal direct loans are eligible. Number 2, you need to be enrolled in an income-driven repayment plan in order to pursue public service loan forgiveness. So you're using one of those income-driven plans to pursue PSLF. And then obviously need to be enrolled full-time at a nonprofit or government entity, employed full-time rather, at one of those institutions. So important to note for physicians, even if you're staffed into a nonprofit hospital, if your employer is for-profit, so where your paychecks are coming from, if that entity is for-profit, you would not be eligible to pursue this. You need to make sure that the entity that is cutting your checks is a nonprofit itself. And then you make 120 payments, so 12 payments a year for 10 years. At the end of that time, anything remaining is forgiven, no taxability with PSLF. So it's a really attractive program. The way that you capture the most value from it is by setting yourself up and starting the clock during residency, because you're going to have some low payments during that time. And that's the way that you maximize the end forgiveness. So make sure if you did think you would be at a nonprofit post-training, that you've got the clock ticking and you set yourself up for this while in residency. So now we can compare and contrast federal loan repayments. Those options I just talked about. How do they compare to private loan refinancing, which is what we do at Laurel Road? In general, federal loans are going to be more flexible. You have a longer term of forbearance, a longer repayment option out to 30 years. Those income-driven repayment programs are available to you. Public service loan forgiveness available to you. In-school deferment available to you. That's not the case if you refinance. You're basically giving those things up. And so I'm sure you would think to yourself, why would I do that? The trade-off is when you refinance, you're oftentimes locking in a lower interest rate. Frankly, that's the only reason you would want to refinance, is to secure this lower rate. So when you're in school, everybody's getting the exact same rate. Whether you're a physician, whether you're in school for a master's degree in art history, it doesn't matter where you went to school, doesn't matter where in the country you are. Everybody in that year is getting the exact same interest rates, and generally they're on the higher side. So once you are graduated, matched to a residency program, practicing beyond that, you're a better credit candidate for a lender. There's a higher likelihood that you are going to pay back your loan at that point in your career. And so what Laurel Road does is we propose to pay off your loans and give you this new loan at a lower rate based on that strong creditworthiness. So that's the trade-off. You're trading some of the federal flexibilities for a lower interest rate when you refinance. The other big difference between Laurel Road and the federal loans is this payment pause, interest pause, which just keeps getting extended. So it complicates things. Obviously, that's not normally the case, but that is only available on federal student loans. And the rest of these are ways that we're similar. So still discharge the loan in the event of death or disability, still eligible for a student loan interest tax deduction, reported as a student loan on your credit, interest capitalization is the same. So, we've tried to mimic the federal programs where we can, but there are certainly some stark differences to keep in mind as well. So a little bit more on Laurel Road and refinancing with us. You're able to choose from 5, 7, 10, 15, and 20-year loan options term-wise. We have fixed and variable rates. For residents, you can refinance. Your payment is only $100 a month while you're in training. So, in light of the modest residency salary, we offer a reduced payment option for those in training. And I think this is one of the rare situations where you can save money both in the short term and the long term. So apples to apples comparison, your current rate is 6.5. You could refinance to 4.5. Your monthly payment is going to go down. You're paying it back over the same period of time. Your interest rate's 2% lower. You're paying less each month. Extrapolate that out over 10 or 15 years, you're going to save money in the long term as well. So a typical physician with $250,000 in loans, paying it back over 10 to 15 years, saving somewhere in the neighborhood of $20,000 to $30,000 on average over the life of the loan. So it's a material savings. Again, it's not for everybody. Those who are planning to pursue public service loan forgiveness or want to utilize income-driven repayments, by all means, those are great options. But certainly there are plenty of folks out there saying, I know I'm going to pay this back out of my own pocket. I just want to minimize interest as much as I can. Oftentimes the best way to do that is by refinancing and locking in that lower rate. And on the topic of rates, get asked all the time, when is the best time to refinance? I don't think there's anyone out there who knows exactly what interest rates are going to do over the next 6, 12, 24 months. Over the last year, they have been rising, a significant rise from where we were in a historic low environment. So rates right now are higher than they were, 8 months ago. I think most folks' expectation is that that's going to continue for the foreseeable short-term future. So expectation would be rate you'd get today is probably lower than the rate you'd get in 4 to 6 months. Now, nobody knows exactly what's going to happen, but what I like about student loan refinancing is there's not fees associated with this when you refinance with Laurel Road. So if you, let's say secured a rate today at 5% and a year from now, the Fed's decreased rates a couple times and rates have come down and, now you could get a 4% rate. You can always refinance your loan at no cost. So that's always an option to you. And I think, maybe take some of the guesswork out of this decision. Lock in as low as you can right now. And if you happen to be able to get a lower rate in the future, you can certainly do that. I mentioned earlier, credit is certainly one of the factors that we look at in determining your eligibility to refinance and the rates that you're offered. So, really want to encourage people to be vigilant about their credit score. Make sure you're checking your credit score at least once a year. Errors can certainly happen. And I think most people are familiar with the idea that your credit score is based on paying your bills on time. And certainly that is part of it. Pay your bills on time, your credit score should be strong. The one factor I didn't realize until I worked in banking was this credit usage level. The credit bureaus don't want to see you utilizing more than 30% of your available credit on your credit cards. So if you had a credit card with just use round numbers, a $10,000 limit, you wouldn't want to spend more than $3,000 a month, even if you're paying it off in full at the end of that month. If you were using more than 30% of what's available to you, that would drag on your credit score. So the easy solution to that would be to just call your credit card company, ask them to extend your line to the point where you're not using more than 30% of it each month. Just that simple step can increase your credit in a really short order and a really easy way to do so. Other factors they look at: credit history. So longer accounts have been open. The more your credit score is going to go up. That's one that just generally tends to improve as you progress through your life. And then they don't love to see a ton of new credit applications in a short period of time. So don't go and apply for a student loan, a credit card, an auto loan, and a mortgage in the same week. That can drag on your score. So just a couple more details on refinancing with Laurel Road. Love to shout out the $550 bonus we give all White Coat Investor readers. So if you would apply through the White Coat website, you will get a check from us for $550, which is a nice bonus when refinancing your loans. We will honor your grace period. So if you're recently graduated, you wouldn't need to start making payments till up to 12 months thereafter. And there's no commitment at all. So by the time I'm done talking here in a few minutes, you could have gone to the White Coat site, clicked through to Laurel Road, submitted some preliminary financial information, and gotten your preliminary rates. If you like the rates, by all means, continue on in the process. If you didn't, there's no obligation to move forward. No impact on your credits, just a soft pull. Also, no prepayment penalty. So if you did refinance with us and wanted to pay the loan back faster, you're certainly welcome to do so. We also offer a quarter point off of your rate for setting up auto pay from a checking account. About 98% of all of our customers take advantage of that. It's a free quarter point off the rate, just going to make your life a lot easier as well. So once you've made a choice how to approach your loans, what's next? What are some other things you can do to reduce the cost of this debt? Be strategic. So if you were able to make overpayments, you'd want to direct those towards your highest interest rate loans first. That's the most effective economical way to pay down debt. Seek out rate reductions. I mentioned that quarter point for setting up automatic payments. Other lenders offer that, other types of loans. So be on the lookout for those. And then if you make less than 75 grand, so oftentimes for residents, you can deduct up to $2,500 a year on your federal taxes in student loan interest paid. So be sure to consult your accountant on that one. And lastly, make your payments on time to the extent that you can. A lot of people impacted by COVID, other factors. If you're unable to make your monthly payment, contact your lender. Oftentimes there's some options available to go on a payment plan so that you don't fall behind, go delinquent, or default on the loan. That was all the information I had for you. I think there've been a number of questions to come in. I think Dr. Dahle and I can go through those, but for anybody who has to jump, I think the message is there is a lot of options out there, especially for physicians. Do your own research. Your colleague's best repayment approach isn't necessarily going to be what's best for you. So, take the time, do your individual research, and be prepared to capture these savings opportunities that are out there in the market.
Awesome. Alex, thank you for such a great presentation, a great overview of the student loan market. There's lots of interesting things about student loans. It felt like in 2022, the game plan changed every week. But it's interesting. One of the things that's happened over the course of the last year is interest rates have gone up significantly, and that's going to affect the interest rate on new student loans too. A lot of people don't understand where their student loan interest rate comes from. And for graduate school, it's basically the 10-year treasury rate plus 3.6%. So if that were, as we calculated as we're recording this, that would be 7.3% student loans, just the regular federal student loans that people are borrowing next year. So while, obviously as rates go up, you can't refinance to as low of a rate as you might have been able to do in 2020 or 2021. You're also going to be refinancing down soon from higher loans that are being given out by the federal government. So that relationship is probably always going to be there. There might be a few people in the middle that happen to get a little bit lower rates on their schooling, and then rates went up such that they aren't incentivized to refinance. But most people are still going to get a lower interest rate by refinancing their loans.
Yep, agreed.
All right. So some questions here for you. Once the federal payment pause is up in 2023, assuming it comes up in 2023,
Yep.
Although it could come sooner. I think it's the sooner of June, at the end of June 2023, or 60 days after the Supreme Court finally rules on the Biden administration $10,000 forgiveness plan. I guess if they ruled really early in the year, that could
Yeah,
be before
that's right.
June 30th. But I think typically they issue their rulings in the summer. So I'm
Yeah.
guessing they will in this case as well. So it probably really is going to be June 30th. But the question is, once the federal payment pause is up in 2023, what happens to those who can't pay their student loans?
It's a fair question. The same federal options are going to exist. So you'll have 3 years of forbearance at your disposal. You can put the loans into forbearance for up to 36 months. Also, those income-driven options are a great way if you're unable to make a comfortable full payment. So they ensure that your payment is based on your income. And if your income took a significant hit, like let's say you lost your job, you could share with your lender, with the Department of Education, the federal loan servicer, that you've lost your job, that you have no income, and they will reset your payment accordingly. So if you had no income, your monthly payment obligation would be nothing.
Awesome. Okay. When student loan forgiveness happens, I think we're talking about the Biden administration plan that's currently tied up in court and headed to a fairly conservatively tilted Supreme Court. Do borrowers need to wait to receive that before they refinance loans?
Well, if you had federal loans that you hope to have forgiven through that proposed forgiveness, or you would need to wait until that ruling took place and some instructions were given on what exactly the process would be. Now, keep in mind, as it's been proposed or announced, it's only for those making under 125,000. So if you're a physician making more than that, even if this were to pass in its current state, would not apply to you. It's very unlikely they would broaden who is eligible to have their loans forgiven. But if you're making less than that, if you're a resident, you would, at a minimum, what we've seen a lot of people doing is just leaving $10,000 or $20,000, depending on if you took Pell Grants, out of their, leaving those loans federal, and refinancing the rest of the portfolio, because that's the maximum amount to be forgiven, and as long as you leave that federal, should this be approved, you can have that forgiven if and when it happens.
Yeah, I think the bottom line is people have got to understand that when they're talking about student loans in the news, when they're talking about PSLF, when they're talking about IDR programs, when they're talking about, student loan forgiveness, that all goes away when you refinance.
Yep.
Those are federal student loan benefits, federal student loan features that you do not get on private loans. And there are a few people, I've had a few readers, and most of them actually have their student loans paid off now, which tells you something about their approach. But they refinanced in like January and February of 2020, just before the student loan holiday happened.
Yep.
And really felt kind of hosed by it, right? They're like,
Yeah.
I could have been at 0%. Now I'm at 2%, because they got these awesome rates back then.
Yes.
So, but still, they're like, man, I feel like I kind of got hosed. And that is a possibility. Anytime you leave the federal student loan system, you can miss out on anything that might happen that nobody could have predicted, like the student loan holiday and how long it's lasted. So I think people really need to understand that and really need to go, okay, I'm going to pay back my student loans. I would love to get a little bit of help from a lower interest rate to help me pay them back faster, or to be able to use money to do other things while I'm paying them back. I recognize that I'm giving up a few things to do this, and you've got to be okay with that. And that's why I think most people, private loans, you can refinance anytime. Obviously, you can, coming out of med school, you can
Yeah.
refinance your private loans, but I think most people
Yeah.
kind of wait until the end of residency to start refinancing their federal loans, just because they want to make sure they're not going to be going to a job that's going to qualify them for PSLF.
Yeah. Absolutely.
But I like, and you made this point very well in your presentation. I say start refinancing student loans, because I encourage people to refinance early and often. When rates go down, when your credit score gets better, when your debt to income ratio gets better, refinance them again. In fact, some people, they can't refinance when they come out of training. I had a podcast I recorded with somebody earlier today and they had $780,000 in student loans when they came out of a
Wow.
dental specialty residency.
Yeah.
Nobody would refinance them. They're making like $150,000 a year. They owed 780. Everyone's like, I'm not touching that.
Yeah.
Because this isn't the federal government. They don't give you a loan just for having a pulse and getting into medical school. So it was 2 or 3 years into her repayment before she could actually refinance those loans.
Which probably in her best interest anyway, right? I mean,
yeah,
it would have been a burden to pay
right,
on a $780,000 standard payment
right.
while you're making 150. So
Absolutely, she couldn't afford to do it. So it was,
right.
they did her a favor, really. But
Yeah. Yep.
okay. Next question. Will the interest from 3 years of the payment pause be added to the balance of loans when repayment starts in 2023?
Normally it would. So normally if you're not paying, what's accruing on the loan while you're not paying gets capitalized, tacked onto the balance at the end of that period of non-payment. But in this instance, that is not the case. You have not accrued any interest in these last 3 years. So there's nothing that's going to be added back onto the balance once the loan gets turned back on, whenever that is.
One of the benefits of the student loan holiday. And a lot of docs, they're like, oh man, I make too much money now. I'm not going to get that $10,000 in forgiveness. They don't realize that having their interest at 0% is worth way more than that. I mean, if you owe $300,000 in student loans at 6%, that's 18 grand a year in interest.
Yeah.
Right? You're basically getting this, great cash benefit, from the government every year that this holiday goes on. It's even better than getting $10,000 of forgiveness.
Absolutely right.
Yeah. Okay, here's a question about Laurel Road. Does Laurel Road help those who are pursuing PSLF?
We recently acquired a company that does. We acquired a company called GradFin. They help assist those who are pursuing public service loan forgiveness, can facilitate some of the paperwork, can ensure that you're in compliance of those guidelines that we talked about for the program. So yes, and they offer 30-minute consultations, can talk through the program and your eligibility for it. So yes, if there was interest in that, we do have a resource now through GradFin to help.
Awesome. All right. Now, how about if you have different federal loans or multiple federal loans, can you combine those and keep them as a federal loan?
Yes. So that would be consolidating effectively. If you wanted to keep your loans federal, but combine them, all you would do is consolidate through the Department of Education. You'd wind up with that one direct loan with the same interest rate effectively that you have. They take the weighted average of your current loans, and that becomes the new rate on your consolidated loan.
Okay. If you have a combination, like a lot of people, particularly people who had to borrow a lot of money for their schooling, they've got a combination of federal and private student loans. Can you refinance them all together?
You can. Yeah, and a lot of people do that as well. I mean, there have been times, and I'm sure there will be in the future, where refinance rates are exceedingly low and people want to take every single student loan they have and lump it into that refinanced loan. So yeah, we see a lot of people will combine their federal and private loans into one loan via refinancing.
Okay. How about do the 3 years of this payment pause count toward PSLF and or repay?
It does. So these months, they're classifying them as quote unquote $0 payment months. They count in the pursuit of any forgiveness. So public service loan forgiveness, repay, pay as you earn, any of those. This period of time, while the interest and payment holiday has been in effect, has counted as progress towards that forgiveness.
Okay. All right, I got a few other questions that I think are worth talking about just by way of clarification. One of which is about a pretty unique program you have. Not a lot of lenders have this, which is a plan for residents. For the most part, most residents can't refinance their student loans until they have an attending contract in hand. You guys have a resident program. Can you give us the details of the resident program?
Yeah, definitely. We were the first lender in the country to start offering this back in 2015. It's a a refinancing option that allows residents, as soon as you've matched to a residency program, so in your final year of medical school, you can refinance, lock in, this interest rate, and the payment is only $100 a month while you're in training. You also have the ability to extend that $100 monthly payment up to 6 months post-training. So you could give yourself a little bit of breathing room as an attending before you start making full monthly payments. And that's what does happen once you start practicing is you would, begin on a standard repayment term at that point. So, 5, 7, 10, 15, 20 years, you can start your repayment term effectively post-training at that point.
And how much higher interest rates should people expect compared to what they might get, as they're leaving residency, what they'd get under this resident plan when they're starting residency?
Yeah, there's a range. It is higher though. To your point, the rate that you would receive as a resident is higher than you would as an attending, and I think that goes back to again, just look at this logically. A resident, you're still a little bit more risky to pay back the loan than someone who has made it all the way through training and is an attending physician. So your rate is probably a point or maybe a point and a half higher as a resident. And what a lot of people will do is then again refinance once you sign that practicing contract and secure an even lower rate in the future.
Yeah, it seems to work out okay though, because the loans that most people coming into residency are refinancing are private loans,
Yes.
which are often at a higher rate anyway. So
And
you've still got that delta between the rate you have and the rate you're refinancing to. And if they're only $100 a month payments, and you can actually afford to make those during residency.
that's the other thing, right? A lot of private loans don't have a reduced payment option during training. They would ask you to make full regular monthly payments while you're a resident. This program does not.
Yeah, that's just a non-starter for most residents, I think. Let's talk a little bit about some of the other benefits of being in the federal student loan program. If you're permanently disabled, your student loans go away. If you die, your student loans go away. Can you describe what happens once someone is refinanced with Laurel Road in the event of either of those situations?
Yeah, so those are actually the same with Laurel Road. If you were to pass away, you were to become permanently disabled, your Laurel Road loan would be forgiven in the same way that your federal loan would. Even if you had a cosigner, we get asked that a lot. If I have a cosigner on the loan, something happens to me, does the cosigner become obligated to pay it back? And they don't. So cosigner would be forgiven as well if anything like that happened to you.
That's a very liberal policy, much better than a lot of your competitors.
Yep.
So what are there? You mentioned that if they have, their payments auto deducted from a bank account, they get the 0.25% reduction in their rate. Does it have to be a Laurel Road bank account? Do they have to open a bank account with you, or can this be any bank account?
Yeah, it's a good question, and it's a new revelation for Laurel Road the last couple of years. So we've always offered this quarter-point rate discount for making automatic payments from any checking account. And in the last couple of years, we started offering what we call bundled checking. So if you're refinancing with Laurel Road and you open a checking account with Laurel Road, we will give you up to an additional 0.55% off of your interest rate in light of opening that checking account. So you don't have to. You can still, refinance with us and make automatic payments from any other checking account. But if you did open a checking account with Laurel Road, you can get up to an additional 0.55% off the rate.
Well, that's huge for somebody with $400,000 in student loans. I mean, that's a couple grand a year.
It's since we launched it, it's about a third, 40% or so of borrowers are taking advantage of it because it is such a significant discount. And typically your checking account, you're not really seeing any significant benefit from it. If you just had a Bank of America account, for example, you're not seeing any benefit from having that. Whereas this, significant loan rate reduction by moving it to Laurel Road.
What other services does Laurel Road offer that doctors would be interested in?
Yeah, so we were acquired by KeyBank almost 4 years ago now. we've begun offering more traditional banking products tailored to physicians since that key bank acquisition. So we offer a high yield savings account, in the mid to high 2% range. We offer loyalty checking, where you can get, even if you didn't have a student loan, you could get cash back on your checking account every month. We have physician-specific mortgages, which has been really popular. So most of our mortgage volume that we do is for physicians, because we have this 0% down true physician mortgage with no PMI. We offer personal loans at lower rates and higher lending limits for physicians. We have a student loan cashback credit card. So we've started to offer financial products, more traditional financial products, that you'd see at other banks around the country. Student loan refinancing is certainly a niche. Most banks don't offer this, but we've started to expand that offering into other financial products. But again, tailored to physicians. Many of those have this, preferred physician terms. Mortgage does, personal loan does. Higher balances, lower down payments. On personal loans, residents can pay only $25 a month during training. So, I think we understand the, physician career path. We understand, it's a group that's very rarely unemployed and very rarely defaults on debt. And thus, we give some really attractive terms in light of that.
Awesome. Well, this is great. For those who are interested in looking into refinancing with Laurel Road, you can get more information at whitecodeinvestor.com/Laurel Road. As Alex mentioned earlier, you get a cashback bonus if you go through that link, or if you go to Laurel Road/WCI, that you don't get if you just go to the regular Laurel Road website. So you need to go through the WCI links to get that cashback bonus. We are also, through the end of the student loan holiday, throwing in one of our online courses absolutely for free for anybody who refinances their loans through that link. So that's whitecodeinvestor.com/Laurel Road. Alex, thank you so much for this presentation, for the WCI community, and for your time, and for all the great services that Laurel Road is offering us.
Yeah, thanks so much for having me. Look forward to continue working with White Coat for the coming years as well.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.